Hello, I'm David Buckland and welcome to this week's Video Insight. Today I'm being accompanied by Gary Rollo, Portfolio Manager for the Montgomery Small Companies Fund. For context, the Montgomery Small Companies Fund has been running for nearly 4.5 years and it's outperformed its benchmark by 5.2% per annum after expenses. Gary, recent months have been quite exciting for the Montgomery Small Companies Fund. I noticed 4 of our stocks, Life 360, Megaport, Superloop and Audinate, just calendar year to date, the first approximate 9 or 10 weeks of this year, are up on average about 45%. So many of them have obviously responded very positively from the reporting season, and 45% in 9 or 10 weeks is nothing to be sneezed at on average.
Yeah, that's. I'll take your word for all that. But the reasons why these things are happening is the most interesting context. And what we've got to do is bring it back to what we call the setup. And the setup here is that small caps have underperformed big caps for just over the past 2 years now by around 25%. And that's not normal. And what we're seeing is the market responding to the earnings results of these companies to say, actually, these businesses are in good shape. And let me tell you why. These 4 businesses that you've identified there, they are growth companies. And a couple of years ago, the stock market was looking at growth almost at any cost as being the right way to go. We had the inflation shock in 2022, and the stock market changed its mind on that, and it took these companies some time to adjust their cost structures and get themselves back in business. And so what they all did is they raised prices, they cut costs and they cut capex. And from that, they're able to demonstrate that these are the best business models out there, yes. Great profitability, and now you have that optionality on growth being observed by the market. So instead of having growth at any cost without regard to earnings, you've now got a profitable business that's growing, and the stock market likes that and has responded to that accordingly.
And it's interesting that a number of them have moved into a position of positive cash flow just relatively recently.
Yeah, that's right. Well, the stock market, I suppose, told these companies, show us your earnings power, show us your cash flows, and then we'll come back and discuss what valuation regime you should be on. And the stock market's surprised by just how profitable these businesses can be, whilst not sacrificing any of their growth opportunity or optionality. And that's what we're seeing now. These businesses are being re-rated as profitable growers, and that's worth more to the stock market than what they were before.
And relative to big caps, it's interesting that many of them have an incredible runway of growth, and I'm not talking about 10 or 15% for the next per annum for the next few years. I'm talking 25s and 30s type numbers, which is it's an exciting place to be, Gary.
Look, that's right. We look for businesses that are small and more early stage. And what we're doing is we're looking for them to face off against larger end markets, and with that ability to go and take market share. And what you get in combination, if they're successful, is a small business growing fast into a large market, and the market likes that. That gives the opportunity for significant profit growth. And like you say, we're not trying to sort of find businesses that are growing GDP-like. We're trying to find businesses that can grow many multiples of that for a long time, and those are the types of businesses the market wants to rate.
And in terms of that setup, to what degree has that enormous discount of smalls to larges, I think at one stage it was approximately 30 percentage points discount. To what degree has that 30% sort of started to come in just in recent sort of month or two?
Look, I think the best way to frame it, and we might actually put a chart on the screen here, if you look back over the last decade, the returns between smalls and bigs have been relatively consistent. In the last 2 years, we've seen a significant deviation. The extent of that deviation is somewhere around 28, 29% when it was at its max. Now it's about 25. And the reality is that the stock market is responding to these growth companies having the future that they should have. And as a result, you're starting to see smalls catching up with bigs. A couple of stats. In the last 26 months, bigs have outperformed smalls 18 of those months, and smalls outperformed bigs 8. In the last 6 months, it's 3-3, and in the last 3 months, it's 2-1 to smalls. So I think the implicit question to ask is, are we starting to see smalls returns move to more normal? It's impossible for us to tell, but we think that that event is starting to happen now as investors appreciate the quality of the business models, and the growth optionality in smalls is undervalued.
Thanks very much, Gary. Ladies and gentlemen, as you've heard it from the horse's mouth, we think that discount is certainly starting to come in. And as inflationary pressures slow, pressure on interest rates dissipate, it certainly looks like a very good probability to us that smalls have a wonderful runway, particularly the growth area of the small cap index.
Thanks, David.
That's all we have time for this week. Please continue to follow us on Facebook and X.